December 2025. Outside, the wind howls. But what's even more unpredictable than the weather is the market. Standing at this juncture, I won't ask how much you've made this year. Instead, I want to know how you're feeling right now. Are you watching certain assets surge, heart-pounding, terrified you're about to miss the last train to wealth, FOMO? At the same time, are you staring at your account balance, trembling, afraid one wrong move could wipe out years of hard-earned savings? Fear? Good. If you're anxious, it means you're still alive. It means your financial instincts are still sharp. This tension, this inner to-go-for, is the prelude to a market shakeout. In the coming year, wealth won't vanish into thin air. It will simply undergo a grand and brutal physical transfer. Like water flowing downhill, it will move irreversibly from the impatient, the reckless, and the get-rich-quick dreamers into the hands of the calm, the patient, and the disciplined. This article isn't here to pump you up with empty hype or push some 100x moonshot stock. That's not investing, that's gambling with your life. This is a survival and offense manual for ordinary people, the middle class, and those just beginning to build real wealth. Whether you're holding $500 saved from frugal living or $5 million sitting in your account as 2026 approaches, you must find a strategy that works for you. Because the rules of the game have changed. The end of the easy money era. For the past couple of years, conservative investors had it good. You didn't need to read balance sheets or study charts. Just park your money in a bank's high-yield CD or a short-term bond fund, and you could comfortably earn 5% or more in risk-free returns. That era of earning while you sleep officially ended by late 2025. The Federal Reserve has begun cutting rates, not just a US story, but a global signal that liquidity is tightening. Bank deposit rates may soon fall below 3%, even 2%, and risk-free yields will struggle to outpace real inflation. What does this mean? If you keep your money locked in a savings account, your wealth is shrinking in real terms. Inflation may be slowing, but it hasn't stopped. When risk-free returns can't beat inflation, saving becomes a form of loss. So where will the money go? Money is greedy. It must move. It will flow out of cold bank vaults and into assets that can deliver regular income, the real opportunity of the next year. The key is to position yourself at the destination before the crowd catches on. But beware. This is where the traps lie. When bank rates drop, the market floods with scams, P2P schemes, shady guaranteed return products, or pre-IPO shares promising 10%, 20% annual yields. Carve this into your mind. In a low-rate world, anyone offering double-digit risk-free returns isn't doing charity, they're likely after your principal. In 2026, capital preservation is priority one. We're investing, not gambling. Defense first, the 30-40% safety net. Before you attack, you must defend. For most people, 30-40% of your portfolio should be in assets that won't break in a storm. This is your shock absorber. Even if the market crashes or a recession hits, this portion keeps you sleeping at night so you don't panic sell at the bottom. So what are the best defensive assets for 2026? Don't chase flashy startups with slick PowerPoint decks. Invest in companies that collect rent, not literal rent, but dividends. Look for firms that have increased their dividends every year for 10, even 20 years. That's a sign they're not just profitable, they're cash-rich and shareholder-friendly. 1. Consumer staples, the power of necessity. When the economy booms, people brush their teeth, drink coffee, and buy shampoo. When it tanks, they still do. This is the power of necessity. Consumer goods, giants, and food and beverage leaders may not double in a year like tech stocks, but they're incredibly resilient. In turbulent times, they're your safe harbor. 2. The hidden winners of the AI revolution, utilities and power. This may be the biggest under-the-radar opportunity of 2026. Utilities and power companies used to be seen as boring, slow growth, defensive plays. But the game has changed. AI's explosive demand for computing power is outpacing the grid's ability to supply electricity. This is a classic supply-demand mismatch. As tech giants scramble for power, companies with stable grids and nuclear capacity gain pricing power. Think of it. A single AI data center can consume as much electricity as a small city. Once considered stodgy, utilities are now the pick-and-shovel play of the AI era. Without power, even the fastest chips are useless. So firms with reliable energy infrastructure, especially nuclear, are evolving from defensive stocks into essential growth plays. Offense, where the real money is made. For years, everyone knew Nvidia was printing money, the ultimate pick-and-shovel play. Everyone was mining for gold, and Nvidia sold the shovels. But by 2026, the shovels are everywhere. The new question is, who's actually digging up the gold? Stop obsessing over large language models. The model wars are now a money-burning contest. Look instead for companies using AI to solve real problems and generate real profits. Is it the biotech firm that cut drug development time by 50% using AI? The logistics giant that slashed fuel costs by 30% with AI-optimized routing? The bank that transformed customer service efficiency with AI agents? 2026 is the year of AI implementation. The winners won't be the ones building the models, they'll be the ones using them to cut costs, boost margins, and dominate markets. Also, watch companies solving AI's biggest bottlenecks: energy, cooling, and chip efficiency. The new digital gold. When it comes to offense, crypto can't be ignored. But in 2026, reframe your view of Bitcoin. It's no longer a lottery ticket. With ETFs approved and institutional adoption growing, Bitcoin now functions more like digital gold. Its role? Hedge against inflation, insurance against fiat currency debasement, a store of value. Advice: don't go Allen. Don't trade it like a casino. Treat it as a small allocation, say 1-3% of your portfolio. If it soars, you benefit. If it crashes, unlikely, but does possibles and derail your life. That's the point. 3 tactical playbooks. Choose your path. Stage 1, the starter students. Early career, under $50K. Profile: you're young, with limited savings, but time your greatest asset. Pain point: you want fast returns, but you're vulnerable to scams. Core strategy: set and forget dollar cost averaging DCA. Don't waste time on charts or day trading. Your capital is too small to make a difference, and the costs, time, fees, stress outweigh gains. On portfolio blueprint: 70% in a tech index. For example, NASDAQ 100 ETF QQQ, a bet on the future. Ride the wave of innovation. 20% in a broad market index. For example, S&P 500 VOO. Anchor your portfolio to the US economy. 10% in lottery tickets, a small stake in Bitcoin or a high-conviction AI startup. Treat it like a IT lottery. If it fails, no harm. If it wins, it could accelerate your journey. Mindset: when the market drops 20%, celebrate. For DCA investors, downturns are like Black Friday sales. Buy more shares at lower prices. In 20 years, you'll thank your younger self for staying the course. Stage 2, the builder middle class, family provider, $50K, $1M. Profile: you're the backbone of society-amized mortgage, kids, responsibilities. Pain point: you can't afford big losses, but you can't afford to fall behind either. Core strategy: core plus satellite. Stable base with room for growth. Portfolio blueprint: 60% in total market index, for example. Boring but bulletproof, your financial bedrock. 20% in sector ETFs. Go bold here. Semiconductors, healthcare, or clean energy. Target alpha: outperformance. 15% in dividend stocks or bonds. Generate cash flow for emergencies, job loss, medical bills. 5% in play money. Experiment with individual stocks, options, or crypto. If it vanishes, your family's future stays intact. Keyword: balance. Don't chase beginners' others' returns. Your goal is steady compounding, not a financial avalanche. Account. Stage 3, the preserver entrepreneurs, pre-retirees, over $1. Profile: you've built wealth, now protect it. Goal: avoid losses. Min taxes: you don't need 20% returns. 5% $1M is $50K year. That's real money. Core strategy: diversify. Build anti-fragility. Portfolio blueprint. And 1B is main holdings: low volatility, high dividend blue chips, Generate passive income to fund your lifestyle. Tax-advantaged bonds, municipal bonds in the US, or similar tax-efficient instruments. Alternative assets. If you have access, consider premium real estate or top-tier private equity. Requires expertise. Gold. Physical assets. Your ultimate insurance policy. 2026. The year of the disciplined investor. The days of buy anything and get rich are over. The future belongs to stock pickers, to the smart, to the disciplined. For here's your action plan. Right now, open your brokerage. Set up an automatic monthly transfer, $500 or $1,000, to buy the S&P 500 or NASDAQ 100. Then, delete the trading app, forget the password. Do this, and you've already beaten 90% of investors. Don't trade on headlines, they're noise. Don't follow rumors, they're traps. Only action changes your bank account. Only time proves value. The future belongs to the optimistic and the prepared. In this wave of wealth transfer, may you be the one catching the tide, not the one left stranded when it recedes. Good luck. See you at the top in 2026.